Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in my regular Wednesday episodes, I talk about the theories, methodologies and principles associated with investing. The aim of these case study episodes is to share how the application of that approach to formulating advice has worked out in real life situations. So that is, I talk about some of my clients that I've been working with over the past number of years. And today's case study is some clients we started working together in 2010, so about 14 years ago. So let's start with the numbers first in terms of, where did they start from an asset perspective and where are they now? And then as usual, I'll round it out to talk about, what are some of the things they've done well and some of the things they could have done better, reflecting on that sort of wealth journey. So as I said, we started working together in 2010. Their net worth was about $870,000 at that stage. Really mostly in the family home. So the family home was worth about $850 with about $190 owing, so had quite a bit of equity in it. They co-owned a property in another part of Australia with their family members, which is kind of just a holiday property, if you like. So their share, the value was worth $150. They had $105,000 of debt against that property. They had some shares, some Australian shares, about $65,000. And super, he had about $29,000. She had about $69,000. So a relatively low asset base, but at the stage they had, a bit of surplus income. The kids weren't in secondary schools yet, and they wanted to quite astutely map out a long-term strategy, of course. So fast forward 14 years, where are they today? Well, their net worth is north of $5.4 million. Their family home is now worth $2.9 million. So it's gone from $850 to $2.9 over the last 14 years. Pretty extraordinary. No debt against that anymore. They've got an investment trust that owns a residential apartment. There's no equity in that really. A commercial property where there's about $500,000 of equity in, and a share portfolio worth about $235,000. So in the investment trust, they've got about $735,000 of equity in that investment trust. Personal share portfolio, they're about $250, but of that $250, $90,000 is kind of earmarked for the kids, for future housing deposits and so forth. So that's just invested in a diversified ETF for them. Super is now worth $820,000. So as I said, it was about $100,000 odd 14 years ago. So that's 8 times more than what it was when they started. Of course, they've been making contributions. Anyway, that 820 consists of about 620 of shares and about 200 grand of equity in a small apartment. The country property they co-own, the equity in that's about 250, and they got about 250 of cash. So that's kind of the rundown in terms of their net worth. And if you look at the contribution, so they started at 870, it's now 5.4. Where has that contribution come from? So just broadly, the home, about half of it is equity in the home, 2.25 million, so change in value, a 720,000 increase in super, and about another $1.2 million in other investments, which are primarily cash, shares, and the commercial property. That really sort of covers that amount. So it's kind of good. Like 50% is through the lifestyle asset, the home. And really, I keep talking about in this podcast how a home can end up being a great investment, and about 50% from investment assets, which is kind of what you want to see. So I'll describe what we've done over the last 14 years. And then, as I said, I'll round it out and share some key insights, if you like. So we invested in a commercial property. The client used that property for his business, but it was in a relatively good location in Melbourne. As I said, it's performed okay. We purchased 2 investment grade apartments, which is a common theme in these podcasts, just because that's what we were doing back then 15 years ago. Unfortunately, pretty poor timing, as I've spoken about in the main Wednesday podcast and these case study episodes. They haven't performed as we might have expected or hoped that they would. We only started investing in shares about 3 to 4 years ago, so we haven't been doing that for the whole time. That's where we've accumulated that share portfolio in the trust, about $235,000 worth. And the clients really are in a position now where they've got net investment assets, so excluding their home, of about $2.3 million, and they're in their sort of mid to late 50s. So they've done well, although they just need to let those assets compound for maybe another 5-ish years, but their success really isn't dependent on contributing more to the investment base. So that is that they've got enough investments now. It's really just covering living expenses really for the next 5 years. They don't necessarily need to work that hard. Just let those assets compound a little bit more. And in 5 years' time, that $2.3 million might be something, well, should be north of $3 million, which should be enough for them to enjoy a comfortable retirement. So all in all, not all investments have worked out perfectly well, just from a timing perspective. They're all good quality assets, although I'll talk about that in a second, but they're in a really good position. Okay, so let's get into it. 4 things. What are 4 things that I reflect back and think about what I could learn from their situation? As I said, about half of the increase in wealth is a result of their family home. They own a double-fronted Victorian home in the suburb north in Melbourne, which is a pretty good suburb. And I think what this tells me is, or demonstrates again, is that quality always performs well in the long run. So having a quality asset for your home obviously delivers some lifestyle benefits. It's well located. There's no doubt some positive lifestyle attributes as a result of living in that location, but also, and perhaps as equally important, it's delivered some strong capital growth without incurring any capital gains tax. And that's why I keep talking about this in the podcast, because it's something that I've observed working with clients over the last 20 years, that if you can get that right, it adds a bit of icing onto the cake in terms of improving your asset position. Even if all the investments don't work well, if your home is well located, that's a great outcome. And quality is always the key thing here. And I've had a few questions from listeners about, sort of secondary suburbs versus blue chip suburbs. I don't think that's really present in the data over the last 10 years. I think there's been a lot of sort of outer ring suburbs that have done okay. In the long run, that's unlikely to persist. You should, in the long run, always get better performance from suburbs that have a greater imbalance between supply and demand. The second observation is the commercial property. Now, I don't know if we were involved. I don't think I was working with these clients back in 2013 when they purchased the commercial property, and I don't even know how involved we were in that process. But as I reflect back now, they bought in Abbotsford. They could have just spent a little bit more money and gone into a better location, say Collingwood in Melbourne. Now, you don't need to really know Melbourne very well for me to make this point, just realizing that Collingwood has some better attributes than Abbotsford. And another client bought a commercial property in 2008 for about $1.1 million and sold it in 2020 for 3.2. So that's about 9.1% compounding growth. Whereas this client, I know the years don't really align very well. This client spent 907 in 2013 and he's enjoyed 4.7% growth. So I can't help thinking that perhaps in 2013 he should have spent 1112 to get into a better area. And as a result of doing that, maybe his compounding capital growth rates over the last 11 years would have been better. I'm not saying that for sure, but I suspect that would have been the case. And if we had been involved in that conversation, or at least if we involved that conversation today, that's what we'd be talking about. So I think it sort of gives us the evidence to show that if we're going to compromise in terms of location, if we compromise a little bit in terms of budget, that is going to have an impact on the growth rates. The third observation is doing something is often better than doing nothing. So yes, about sort of 10, 14 years ago, we invested in a couple investment grade apartments and they haven't performed as well as we hoped. And it'd be nice to say, well, we should have bought houses back then, 14 years ago, 13, 12 years ago, but we couldn't probably have done it. Like, it was a certain price point that we entered in the market. We were conscious of cash flow. They had anticipated private school fees in the future. You can only do what you can do, right? So it's good with the benefit of hindsight to go, well, we should have chosen a different asset style or quality. I still think these assets are going to work, by the way. They're very well located. They use a buyer's agent to select them. They're good quality assets. They just haven't delivered the returns yet. And I think that's the thing, right? People might look back at assets assets that they hold, but really you've got to put yourself in the mindset of where you were in the year that you bought them, and particularly where you were from a financial standpoint as well. And whilst you might have made a different decision, you make the best decision given the information you've got. And in their situation, better do something than nothing. If nothing else, a mortgage is a forced savings mechanism as well, so they're being able to, carve off some money and generate some equity in these properties. And fourth, cash flow has always been a challenge for them. Managing cash flow, carving off that amount to invest each year, that's been a challenge. I mean, part of the challenge has been private school fees for 2 children for 6 years. That's a costly exercise, of course, but it's always been a bit of a challenge. As I said, getting into the market, gearing earlier on before those school fees came into play was worthwhile. Again, random distribution of returns hasn't worked perfectly well for them, but as a general rule, that's always a good strategy. But managing cash flow is really important. As I said, these clients are in a really good position, I think. Another 5 years' time, they'll be in a substantially better position. They've made some good sacrifices and some good financial decisions, but cash flow is certainly a key element to that. As I said in these case study episodes, I like to look for, what are some positive things and what are some things that we could have done differently or learn from. And by sharing these case studies, hopefully we all can learn something from looking back. I've kind of like the whole exercise of going back and having a look at where these clients started and where they are now. Okay, let's get into some listener questions. As I always invite listeners to send any questions to questions@investopoly.com.au. My plan is to get through as many as possible. So Eric writes, in today's episode, and today's episode was episode 314 on the 24th of July 2024, and I will answer these questions that I get in chronological order, but I just wanted to cherry pick this one that I received last week because it's a really important one. Anyway, Eric says, in today's episode, you discussed about how much super is required in retirement. Whilst on the same topic, I have a few questions. The first question is, you mentioned $120,000 a year for living expenses. Is this per person or per couple? Well, Eric, it's per couple. Generally, if you're per person, maybe you're spending a little bit less than that, maybe something between 80 and 100, but you can't necessarily divide it by 2. And when I say these numbers or talk about these kind of numbers, these are the numbers that most people will aim for to have a very comfortable retirement. And Eric's second question is, when would you consider starting a self-managed super fund? My wife and I are in our late 30s and have combined super of around about $500,000 with UniSuper. We've been encouraged by our accountant to start a self-managed super fund to minimize fees. What are your thoughts? Well, Eric, my thoughts are it's absolute nonsense and you should get a new accountant. And in fact, this is the reason why I wanted to answer this question, even though I only received it last week and I've received plenty of other questions well before it. I thought it was a really important question to answer. So let's go through the numbers. UniSuper for a growth asset class, and if you're in your late 30s, you should be growth or maybe high growth, charges 0.66 of 1% as an investment fee and $96 per account. So therefore, I've worked out that you and your wife are paying about $3,500 in admin and investment fees in total with UniSuper. Okay, so that's $3,500. Let's compare that to running a self-managed super fund. Well, you're going to have to pay for audit accounting costs, and they can range, the cheapest is probably $1,000 a year. Most accountants are going to charge $2,000 to $3,000 a year. But of course, then you're going to have to go and invest your money. Well, if you're going to invest it in, say, ETFs and use a variety of ETFs, your weighted average cost is probably going to be around 0.3 of 1%. That's what our portfolios cost. So there's another $1,500. And then the other question is, how are you going to make those decisions? So can you make those decisions by yourself? Because you're pitching yourself against the returns that UniSuper can produce. So if we're comparing fees, we're already probably more expensive to run a self-managed super fund, but now you've got to make sure your performance is just as good, if not better, than UniSuper. And no offense, but you would expect, or I think it's reasonable to expect, these professional fund managers do better than what you're doing. And certainly UniSuper, as I profiled in this podcast before, is my favored industry super fund. So no is the answer. You've got to then go and pay for an advisor potentially to run run a portfolio for you, that's going to give rise to further cost. And so once you add everything up, I don't think it's cheaper. It's almost certainly not cheaper. Notwithstanding, then you've got to deal with all the compliance and paperwork. So it's going to cost you a bit of time. If you value your time, that's not going to really suit you either. When would you establish a self-managed super fund? Well, really only if you wanted to invest in direct property. I'm not suggesting you do or you should, but that's probably the only time you need a self-managed super fund. Otherwise, either a wrap platform or an industry fund is not only going to be simpler and easier, but also cheaper. And a wrap platform gives you full control. Industry fund, you don't necessarily have full control of, as I've talked about. But I just wanted to answer that question because I think it's a really important one. Often a lot of people think about, whether to establish a self-managed super fund. Okay, let's get into the next question now from Stephen. He says, my question relates to an awkward spot individuals or even couples can get themselves into regarding full or part eligibility for the government pension. Assume a single individual has a home that's paid off and an amount in super of around 400,000. What, if any, pension calculations should impact their asset allocation? It seems like a great opportunity to take the above average risk, more in international shares or Australian shares, because if their shares go down, their pension goes up. It seems you don't get rewarded for a slow and steady 7 to 8% return when you could spend 100,000 of your super and get about $8,000 per annum more in a pension due to the way the asset test works. So it's so what Stephen's question or what he's saying is, well, maybe, because it's asset tested, go for high growth because in the years when there's a market correction or volatility, you're going to pick up more from the government pension. So firstly, I'm not a settling expert, but I promise to answer every question. But that's not my skill set or experience. To talk about the asset test for homeowners for a couple is $470,000. So if you have more than $470,000, you'll get a part pension, and the part pension cutoff is just over $1 million, right? So less than 470, you'll get the full pension. Between 470 and $1 million, you'll get some of the pension. And the max pension is almost $22,000 per person for couples. So that's $44,000 a year. If you're single, it's $29,000 a year. So the more you spend of your superannuation, so asset base, or the more you lose from a capital perspective, you get more pension, and that's great. But you're only getting, maximum $44,000 a year. Most people aren't going to be happy with that. That's not going to achieve the lifestyle that you want. Those with less wealth should arguably take more educated risk. So, if I have very limited funds, then really I do need to try and earn as much as possible. And if I can be happy with the volatility, then, having a more aggressive asset allocation is the right approach. I would say that the content that I produce in this podcast and podcasts is more aimed for people that don't want to rely on the government pension. And frankly, I think that's probably the best approach. Okay, next question is from Adam. He says, you've got a large number of high net worth individuals. It's true. I'd be interested to hear about what your plans are for clients with the up and coming 30% tax on balances in super of greater than $3 million. By my calculations, in the years before retirement, if you're a high income earner, it's best to keep the money in super as the tax and capital gains tax will still be better than outside super. Are there any other options to consider? And when retired, it may be worth having more investments outside super to take advantage of the $20,000 tax-free threshold. Would love to know your thoughts. Well, for those that aren't aware, the proposed legislation hasn't been passed yet. Applies a $3 million cap to super, and it applies to anyone that's both in pension or accumulation phase, and anything above $3 million is taxed at a flat 30%. That includes realized capital gains, income, but also unrealized capital gains. So if you have a property inside super and your balance is greater than $3 million and that property appreciates by $1 million over the next 12 months, you're up for a $300,000 tax bill, even though you haven't sold that property. So the way I read it is they're trying to make it so unpalatable that it really forces people to take any excess out of super. The problem is it also applies to people in accumulation phase. So if you haven't met your condition of release, so you're not 60 yet or 65 and still working, you can't take the money out of super. They're going to penalize you either way. So I guess from that perspective, it also makes sure that anyone that's giving financial planning advice would go out of their way to ensure their client doesn't breach that $3 million cap if possible. $3 million inside super is still pretty generous, right? 1.9 is zero tax, and the difference between 1.9 and $3 million is 15% tax or 10% on capital gains. Still pretty generous, right? I think that it should be capped. I think you've got to have some sort of disincentive. So taxing unrealized gains is exactly that. And we're only talking about a very small cohort of the community that's going to be impacted. How will we react to this change with our clients? We still haven't made a firm decision on this, but most likely is we will withdraw the excess from super and invest it in a company. In a company, you're still going to pay a 30% flat tax rate. You don't have to distribute that money if you don't want to, so you can just keep it in the company and pay a flat 30%, or you can pay a dividend out if you don't have any other personal income and take advantage of that $20,000 odd tax-free sort of threshold. You don't pay any tax if you've got $20,000 of taxable income. And most importantly, we're not going to pay tax on unrealized gains in a company. So that's probably the answer, but I wouldn't say there's a one-size-fits-all answer for every client. But a lot of people, particularly in the financial planning sector, are kicking up a lot of fuss about this policy. I don't think it's such a bad policy. In fact, maybe what it should be is just cap it, like just say you can't have more than $3 million inside super, you're forced to take it out rather than taxing unrealized gains. Either way, I don't think it's a bad policy, and I'm sure we can navigate it to our client satisfaction. Okay, that's it for today. Until tomorrow, bye for now.